It's time for another Friday update with your old pal Millennial Moron, now in landscape format. Because I'm trying to get paid, son! I've got 5 stories for you this week. I know it's a lot, but the news has been coming faster and faster recently. First, a group of landlords in Ontario have been put into bankruptcy protection after being sued by private lenders for unpaid debts. They've got about $144 million in outstanding loans, but currently only have $100,000 in the bank. This case involves over 600 rental units, 200 of which are currently vacant, 300 private lenders, 32 lawsuits, and over 1,000 tenants who are caught up in the middle of it. Funnily enough, one of the landlords involved is an influencer with over 200,000 followers who has run a seminar about how to succeed in business. I hope the tickets weren't too expensive. This is basically the scenario I described back in August in my Garbage Math series, where you have real estate investors buying up properties, renting them out at a monthly loss, but relying on price appreciation for profits. Then, instead of selling the property to harvest those profits, they leverage the additional value to acquire more debt, which they use to buy more and more properties, giving them huge amounts of assets, but also huge amounts of debt. This works when interest rates are near zero and property values are climbing rapidly, but now that debt has gotten more expensive, they don't have enough cash flow to cover the cost of the debt. This is basically the next stage of the debt crisis unfolding in real estate. First, we had pre-construction speculators who put down a deposit and never planned to close. Now it's highly leveraged landlords who borrowed millions of dollars on bad business plans. If rates continue to stay high, we could see these problems trickling out to more small investors and individual homeowners. We're also seeing office space operators taking huge write-downs on valuations as vacancy rates remain high, and construction projects being pushed into receivership as they struggle to maintain the cost of loans amid project delays. This has led to concerns about the potential for rising mortgage defaults, as less regulated private lenders have been capturing a larger and larger share of the market in recent years and have much riskier loans on their books, particularly from the price peak a few years ago. Many of these lenders are also highly leveraged, which could push them into bankruptcy if more people start to default on their loans. Next, the Toronto Regional Real Estate Board has released their monthly market stats for January. Prices dropped 1% year over year, with the home price index dropping by 0.44%. However, sales did increase by 37% year over year, bouncing back somewhat from a 14-year low in 2023. Of course, overall sales in 2023 were lower than they've been in over 2 decades, so we'll probably see higher sales for most months through 2024. Keep in mind that January of 2023 was the low point in prices before the rebound mid-year, meaning that we've now broken through the previous low point, and the drop in real value is even larger when you account for inflation. Now, remember last month when I said this? If home prices continue to decline or even stay flat as the 12-month trailing price goes up, we'll start seeing year-over-year losses in the stats. If that happens, expect real estate headlines to start focusing on monthly or quarterly data instead, or looking at metrics like average sale price rather than the home price index. Well, these stats are being described as the real estate market roaring back to life, with the focus being on the number of sales rather than the decline in values. However, putting those numbers into a longer-term context, we can see that the January sales numbers aren't exactly indicative of the market roaring back to life. It's more like a return to a typically slow January market. As I mentioned last month, unless we see a decent rebound in prices, the rise in 12-month trailing prices means we'll see larger year-over-year price declines in the stats, so expect headlines to continue emphasizing the increase in market activity or some other statistic instead. Next, a lawsuit alleging price fixing and realtor fees has been expanded from the GTA to cover all of Canada. Basically, the case is about how anyone listing their home on the multiple listing service used by brokerages across the country is compelled to offer a specified commission to the buyer's agent. Because the seller basically has no ability to negotiate this fee with the buyer side, the lawsuit alleges that this constitutes a form of price fixing. A similar lawsuit was recently successful in the US, with billions of dollars in damages being awarded, so it'll be interesting to see how the lawsuit in Canada plays out, because this could completely change how realtor compensation is structured. It's not confirmed yet, but I might even have a very special guest on my podcast to discuss this case, so stay tuned for that. Next, the Bank of Canada, on behalf of the government, is reintroducing morning auctions of receiver general cash balances, a program which was previously halted in August of 2020 due to lack of interest. This is basically a daytime version of the overnight repo operations where the government lends out their excess cash balances on a very short-term basis to entities like banks who need liquidity for their day-to-day operations. Like with the repo operations, this is not an unusual move in and of itself, but it is somewhat concerning that this is happening while the Bank of Canada is trying to continue quantitative tightening operations to pull excess money out of the banking system, and they still have over $100 billion left to go. The short version is they're trying to reabsorb money that was created during 2020 and 2021, but that's leaving banks short on cash at different times, so the lending rate between banks is creeping above the Bank of Canada's target rate. So the Bank of Canada and the government are stepping in to sprinkle some cash on the market on a very short-term basis through these daily repurchase agreements. This continues to make me a little skeptical about how optimistic markets have been about rate cuts coming soon. I don't think it's a sign that the system is on the verge of collapse, but it does show that we have a lot of opposing forces pulling on our monetary policy. Scotiabank economist Derek Holt seems to have arrived at a similar conclusion, saying that doubling down on quantitative tightening while relying on a patchwork of tools like repo injections and cash balance auctions seems to indicate that the Bank of Canada may be closer to further monetary tightening than they are to cuts. Markets seem to be getting the same message, as the 5-year bond rate has risen by about 50 basis points since the new year. Meanwhile, the BAX market is now projecting rates to only fall by about 75 to 100 basis points by the end of this year. In addition, the confidence in those rate cut projections is falling. This is a big change from just a month ago when they were predicting 150 points in cuts by the end of this year with fairly high confidence. Finally, a whistleblower has revealed that a few HSBC branches have been lending out hundreds of millions of dollars in mortgages to borrowers that have seemingly modest jobs in Canada but are claiming to earn hundreds of thousands of dollars per year from high-paying remote jobs in China. In one example, a part-time hairdresser owned homes in Aurora, Markham, and Scarborough while also claiming to earn over $500,000 a year as a business manager in Guangzhou. Interestingly, it looks like higher interest rates are squeezing some of these straw buyers as well because they were relying on cheap debt for the scheme to work. There's a lot more to this article and a lot of people DM me to talk about it, but if you've been following Canadian housing for more than a couple of years, I'd say about 95% of this is old news. This is really just a new method being used for money laundering with the rise of remote work and the shutdown of casinos in 2020 and 2021. It's well known that Canadian real estate is used as a venue for international money laundering from countries like China, Mexico, and Iran due to our high real estate valuations and relatively lax lending standards, particularly when it comes to things like income verification. We even have terminology like the Vancouver model or snow washing to describe specific money laundering schemes. Personally, I don't see this as the main driver of our housing market issues, especially when compared with domestic buying factors such as mortgage fraud, which is estimated to be as high as 20% of all mortgages. But it is an interesting read, so I'll put the link to this article along with some other background information on money laundering in the Canadian real estate market down in the description box if you want to read it. That's all for this week, so thanks for watching, and I'll see you next time.